the other side of the money market. But before we discuss demand for money, let's just recapitulate what we did last time. Supply of money, if you remember, is the relationship between interest rate and quantity of money supplied. And if you plot it in that space, interest rate and money space, what does it look like?
The vertical line.
The vertical straight line, right? So the supply of money, if you plot it, it would be this quantity of M1, you can say, and interest rate over here. So your supply of money is a vertical straight line. Fixed by whom? Who fixes money supply in the economy? Who supplies money? The Federal Reserve Bank, right? Which is the central bank in the United States. And if Federal Reserve Bank wants to change money supply, either increase it or decrease it, what does it do? How does the Federal Reserve Bank change money supply? What are the tools of monetary policy?
You can change the required amount of reserves that a bank has to have.
That's correct. So changing the required reserve ratio, what else can you do? Go ahead. What is the other one?
You can change the interest rate that a bank charges.
So discount rate you're talking about, right? Discount rate is the interest rate that the Federal Reserve Bank charges from other commercial banks when they borrow money from the Federal Reserve Bank. And what was the most important tool that they use frequently to change money supply in the economy? What is it called?
Open market operations?
The open market operations, right? Which refers to?
Buy and sell government securities.
That's correct. Buying and selling of the existing government securities, right? And that's the primary mode of changing money supply by the Federal Reserve Bank. Okay. So keep that in mind. We'll be using that information again once we are done with the demand for money. So let's talk about the demand for money. So the first question that arises is, what do we mean by the demand for money? So, broadly speaking, we have two types of financial assets available, in the economy. One is interest-bearing financial assets. You can call them collectively as bonds, okay? And the other one is non-interest-bearing financial assets. You can call them money, okay? So you can divide, financial assets into two broad groups, and you can call them money and bonds. Bonds will pay you interest, whereas money does not pay you interest. So you can choose to keep your financial asset in either in the form of money or in the form of bonds or a mix of the two. So,
wait, can you say that again?
Yeah.
Sorry.
So you can choose your, you have some financial assets, right?
Yeah.
You can divide it into either money or bonds.
Okay.
If you hold on to bond, if you own bonds, that pays you interest. You earn some extra income from it, right? Interest income. But if you choose to keep your financial assets in the form of money, it doesn't pay you interest. That's the idea behind these two types of assets. So, the demand for money by a household or a firm that given your financial assets, how much of that financial asset you choose to keep in the form of money, which doesn't pay you any interest. Okay? So demand for money refers to, so demand for money is your how much of your financial asset you choose to keep in the form of money. You can call it just M1. By money, I always refer to M1. Money is transaction money, right? M1. And it includes currency and coins in hands of public, and demand deposits, the money you have in your checking account. These are the two big components of M1. And then you have traveler's checks and other checkable deposits, but composition is not that big. So how much of your financial asset you choose to keep in the form of M1, and that is called demand for money. Is that fine with everybody, what we mean by demand for money? So the idea is that you can choose to keep bonds, you can buy bonds that will pay you interest. Okay? But you're choosing to keep a part of your financial assets in the form of money, which doesn't pay you any interest. Okay? So that component is called demand for money. How much of your financial asset you keep in the form of money. Now we'll talk about why people choose to keep their financial assets in the form of money. We'll talk about that soon. Okay. Is that fine with everybody so far? What we mean by demand for money? Okay. So my next objective is to derive the demand for money, what it looks like. So demand for money is the relationship between interest rate and quantity demanded of money. So at any given interest rate, how much firms and households collectively demand money. And we want to find that relationship. Okay. So before we derive the demand curve, let's talk about the motives behind the demand for money. Why people and households and firms demand money. Let's talk about that. So motives behind the demand for money. So there are two motives behind households and firms demanding money. The first one is called the transaction motive. And the second one is called the speculation motive. So there are two reasons why households and firms demand money. And those motives are transaction and speculation motives. I'll talk about each of them. So let's try to understand what is transaction motive, why people demand money because of this particular motive. Okay. So to understand transaction motive, let's consider a simple example. Okay, you're looking at a household. Let's say this guy earns $1,200 a month. You can choose any other amount, that's fine. But we'll keep things simple. So let's say $1,200 a month. Okay. So this guy earns, his income is, so we're trying to understand the transaction motive. And we have some assumptions underlying the model I'm going to talk about. So it's the first assumption is you're looking at some household, and this household's monthly income is $1,200 per month. That's his income. Okay. And let's also suppose that every month has 30 days. So we are just making it simple for calculation purposes. So every month has 30 days. Again, it's a simplifying assumption. Okay. And thirdly, this household does not save. So whatever he earns, he spends every month. Okay, so no saving. So what it means is whatever you earn $1,200, you are going to spend all of it in that particular month. And let's also assume that this guy spends at a uniform rate of $40 a day. So his spending pattern is very consistent. He spends, so uniform spending rate. At $40 per day. So every day this guy spends $40. And let's also assume that this household has access to two types of financial assets. Non-interest bearing money, which is cash, and interest bearing bonds. So he has two options. So two financial assets. Money, which doesn't pay an interest, and bonds that pay interest. Interest-bearing bonds and non-interest-bearing money, or cash. Okay. So these are the assumptions underlying our model. We want to understand the transaction model, why people demand money, why firms demand money, households and firms in the economy. So let's look at a simple diagram that captures his spending behavior. So let's say on the horizontal axis we have time, and on the horizontal axis we have income and dollar figures over there. And so we are looking at, let's say this is your 1st of January, and then we are looking at 1st of February, 1st of March, and so on. Okay. And let's say $1,200 is here. So this guy, he gets $1,200 on the 1st of the month. And then he spends $40 a day, isn't it, after that? So on the last day of the month, how much money he has left? None. He has nothing left. But next morning, he gets $1,200, next month's paycheck, isn't it? So if you plot that, he is spending at the rate of $40 a day. The slope of the line is basically every single day he's spending $40, it decreases at the rate of 40. That's the slope. Okay? So you can plot that, and you will get his, if you plot his spending behavior, it's going to be a straight line like this. The slope of this line is $40. And next morning, he has again $1,200. So there is a jump, as you can see. And then what happens next? He again starts $40 spending behavior. And by the end of the month, he has nothing left. And on 1st of March, he again has, and so on. Is that fine with everybody? How I plotted it? So looking at this person's, income and spending pattern in this diagram. So we are interested in finding out what is this person's average money holdings or average money balance. How much he keeps on average. How much money he has on average. So to calculate average, you need the beginning of the period money holdings and also the end of the period money holding and divide by 2. That gives you the average money holding for the whole month. Right? So what is his money balance on January 1st? $1,200. And what is his money balance on the last day of the month, January 30th? 0. So 1,200 plus 0 divided by 2 gives you $600. So this guy holds on average $600. That's his average money balance or average money holdings. So let's say $600 is there. So his average money balance or holding is $600. Now, what is wrong with this person's decision making here? He needs only $40 a day, right? He doesn't need more because he spends $40. That's all he needs. So why is he holding on to $600 on average every month when he needs just $40 every day? He can always buy a bond that will pay him interest. He can earn some extra money, right? He can do that. So let's consider one such possibility here. Let's say you can buy a bond on the 1st of the month when you get your paycheck, $1,200. Let's say you buy a bond for $600. The face value of that bond is $600, and it pays you interest at the end of maturity period. Okay. Let's suppose you could buy a bond that expires in 15 days. Okay. Let's suppose that's the case. So, so you basically buy a bond worth $600 face value. So at the end of 15 days, when the bond matures, you get your $600 back, right? And also you get interest for 15 days on that bond. Okay, so basically you are getting more than $600 after 15 days. That's the idea here. Okay. So let's suppose this guy buys a bond for $600 on the 1st of the month. So you are here. So the moment you get your paycheck, you use $600 out of that to buy a bond that will expire in 15 days, mature in 15 days. Okay. Now you are left with $600 out of your $1,200. Now, how long will this $600 last for you? 15 days, right? You spend $40 a day, so 15 times 40, $600. So on the 15th of the month, January, you will run out of money. You don't have money. You spend all $600 you have left after buying the bond. But what happens on the 15th? Your bond matures. And you get your $600 back plus some interest earnings. Right? So, forget, let's suppose that interest goes some other account. Let's not worry about that. We know that this guy's making extra earnings, right, in the form of interest. So we're concerned about $600 that he needs to spend. So his balance goes back to $600 on the 16th, morning. And then he spends that for the rest of the month. Okay? So do you see this strategy? Buy a bond worth $600 that matures in 15 days. Okay? So if he does that every month, that's your 15th, and so on. Right? What is his average money balance now? How much money on average he is holding every month? Forget about interest earnings and all those things. That goes in a separate account. You can't touch it. Anybody? What is his beginning of the month money balance? How much money he has to spend? $600? Because he put away $600 by buying a bond. So he doesn't have access to that. That's not money, right? That's not cash or money in checking account. So he has $600 at the beginning of the month. And how much money he has on the last day of the month? Zero. So what is his average money balance? $300. That's correct. So his money balance is now only $300. So this is certainly a better strategy for this guy, right? The earlier one we were looking at, the first one, he was not earning any interest, right? With this strategy, he is able to earn some interest income, right? And also able to spend whatever he was doing. There's no change in that. So this is certainly a better strategy for a rational human being. Won't you agree with it? Okay. Now, so the question would arise, why stop at just this strategy? Why not do another thing? Let's consider another strategy where you buy two bonds with different maturity periods on the first of the month when you get your paycheck. Let's say you buy one bond for a face value of $400 that matures in 15 days. Let's say 10 days. Okay? And then you buy another bond with a face value of $400 again, but that matures in 20 days. Okay? What will happen then? So if you plot a diagram for that, let me do that. So get $200. And 10, 28, and then again, first of February. This is January. Let's say 400 is here. So what you're doing on the first of the month, you're buying two bonds now. Each of them are worth, the face value is $400. One matures in 10 days, the other one matures in 20 days. So you just have $400 to begin with, right, to spend. How many days will it last? 10 days. So on the 10th, you have nothing left to spend. But your first bond matures. The bond that has a maturity period of 10 days. So you got interest rate for 10 days, plus you got your principal amount back, $400. Now this $400 will last till 20th of the month. So again, now what happens? Your second bond matures, right? And then you have again $400 plus interest rate for 20 days on this bond. And then you can survive, and then this gets repeated. Okay, so this is a buy two bonds strategy. One for 10 days maturity, the other one is for 20 days maturity. And this way, you are able to earn more interest than the previous strategy. Can you see that? Your interest earning would be greater on this, assuming we have the same interest rate for all these bonds we're considering. So what is the average money balance now? Megan? 200. So your average money balance is now $200. Okay. So as you can see, you will say, why not take it a little further? Why stop here? You can always put everything that you get in income in the form of bonds. And whenever you need to spend something, you sell a bond and then get cash for it, and then buy the thing that you're interested in. That way you can maximize your interest earning. That would be the logical argument. But the problem is that buying bond and then switching into cash is not costless. It has a cost associated with it. You have to pay brokerage fee, right? You have to deal with the hassle of maybe you're going to bank or doing it online or whatever your mode is. It will require time. Time has its opportunity cost. So the idea is that this strategy is not costless. You have to spend some money. On the other hand, if you have cash is convenient. Right? It allows you to buy goods and services. You don't have to go to bank or you call your broker to sell your bond first, right? And that gives you a lot of convenience. So there are advantages of having cash. But when you hold on to cash, what is the opportunity cost of that? What are you foregoing? Interest. You could have bought a bond and could have earned interest with that, right? So there is an opportunity cost of it. So the idea is that we are facing this classic trade-off that is present in economics everywhere, right? So if you're in a situation like that, there is an optimal money balance for every individual or firm. So there is an optimal money balance. So this optimal money balance is the amount of money that you will demand, that you will hold, that also allows you to maximize your interest income. So there is an amount of money, given your financial asset, a certain amount of money if you hold in the form of cash, that will give you the maximum interest income. Okay, so you can find that for every individual. We can calculate that optimal money balance. That's the idea behind optimal money balance. Because as you can see, holding everything in the form of bond is not costless. So you might not be able to, because you have to also, incur some cost. So on the one hand, you're earning some, interest income by holding bonds. On the other hand, you have a cost associated with that. So, there is an optimal money balance that will allow you to maximize that interest. So is that fine with everybody so far? So why do people demand money now? Can you tell me from this example? Why do firms and households demand money? Even when it has an opportunity cost in the form of foregone interest income. Why do we demand money? Because it is convenient. It allows us to buy goods and services readily. So that's your transaction motive. We demand money because we want to transact. Even though holding on to money, when you demand money, you are foregoing your interest income that you could have earned by buying a bond. So interest income is the opportunity cost of demanding money. Keep that in mind. Now next let's consider so you have quantity of money, let's call it M1, which is transaction money, cash and demand deposit, and interest rate on the vertical axis. Let's denote it by letter R. So on the vertical axis you have interest rate, which is basically price of money. If you hold on to money, you are going to forego that. So think of interest rate as the price of money. So let me give you two hypothetical interest rates. One is, let's say, 2%, and the other one is 20%. And my question to you is, at which interest rate, 2% or 20%, would you choose to demand more money? At which interest rate, 2% or 20%, would you choose to keep, would you choose to demand more money? Anybody? So the idea is that at which interest rate you are going to forego a lot of interest income, 2% or 20%. When you demand money, right, you are not buying bonds. With that money you could have bought bonds. So basically you are saying, when I demand money, I am foregoing interest income. So which one is, at which interest rate you are foregoing more, 2% or 20%? 20%, right? So if currently in the market, let's say interest rate is 20%, would you demand more money or more bonds? Nobody had an answer for it?
Bonds.
More bonds, that's correct. Because you don't want to forego 20% interest. But let's say if interest rate is 2%, it's not enough to induce you to buy a lot of bonds. You would rather hold on to cash, because cash is convenient. You can always use it to buy goods and services without going to the bank or something like that. Okay? You don't have to sell your bonds. 2% is not very high interest. So you would choose to keep a lot of your financial asset in the form of cash or in checking account. That's your money, basically, transaction money. But when interest rate in the market on the bonds is 20%, you will be tempted to buy as much bonds as possible, given your financial asset. Right? You would hold on to less cash because you don't want to forego 20% in interest income. Does that make sense to everybody? So at 20%, demand for money would be less. Let's say Q1 over here. And 2% demand for money would be 1. Something like this. Okay. So if you connect the two, you get your demand for money, MD. So demand for money is like any other, it looks like any other demand curve, even though there are some differences with your typical market demand for a product. But I'm not going to go into details of that. For the time being, it is an inverse relationship between interest rate and quantity demanded upon. Okay. Now, when you demand money, when you draw this line, demand for money, you are keeping some other variables constant. So this demand for money is drawn under the assumption that the overall price level, as measured by consumer price index, let's say, P, and the real GDP, captured by Y are constant. They do not change. So when you draw the demand for money, which is relationship between interest rate and quantity demanded of money, you're assuming that the overall price level, or an inflation rate, and real GDP are constant. They do not change. We'll talk about that. When they change, what happens? Okay, shortly.
What was P again?
P is your, think of it as inflation rate, overall price level. So P is your overall price level. A change in overall price level, you remember, is inflation rate. So it captures, and this is your real GDP. Is that fine with everybody so far? So if interest rate is high, demand for money would be less, keeping other things constant. And if interest rate is low, demand for money would be higher. Okay? Quantity demanded of money would be higher. Any questions, comments at this point? All right, so it's clear to everybody, it seems. Now, that's your transaction motive. And while discussing it, we also were able to draw this demand for money. Right? It gives you, the insights into it and allowed us to draw this demand for money. Now, next, let's talk about the speculation motive. And then we'll come back to P and Y and all those things, how it affects the demand for money. So, next, let's talk about the other motive. And that's called speculation motive. So the idea is that there are some people who like to speculate on the movement of interest rate. In other words, they like to, gamble on the interest rate movement. So they make a guess, okay, whether interest rate will go up tomorrow or will it fall. And based on that guess, they try to profit from it. Okay? So there are a lot of people, who like to speculate and make money from this speculative behavior. So let's try to understand that and how it also gives rise to the demand for money. The one you saw, the downward sloping line or curve. So before we discuss speculation motive, let me write a statement and then I will try to show you why that's correct. So say the value of an outstanding bond is inversely related to the current interest rate in the market. So the value of an outstanding bond or existing bond is inversely related to the current market interest rate that is offered in the bond. Okay. So that's always you observe that kind of behavior in the market, bond market. The value of an existing bond is inversely related to the interest rate. If value of a bond goes up, you will see interest rate is going to fall. And so on. So let's try to see why that is the case. Why we observe this negative relationship between the value of an existing bond and the interest rate in the market. So to understand that, let's keep things very simple. It's a very rudimentary way to understand the relationship, but it will do the job. You have more sophisticated models to understand the relationship, but I think this would do the job. So let's consider two time periods. Okay. So you got, let's say, time period 1, and then you have another time period, which is time period 2. So time period 2 is basically, you can think of T1 is today and T2 is tomorrow. Okay? So let's say if you buy a bond in time period 1 that has a face value of, let's say, $1,000. So you have a bond that has a face value of $1,000. And it promises to pay you $100 in interest every time period. Okay? We're looking at annual or whatever it is. So it pays you $100. That's the return on this. Or you can say yield on this bond. So it promises to pay you $100. And so basically your return on this bond, or you can say interest income that you will earn, is how much? What percentage? You're buying a bond for $1,000 and you're earning $100 every year. And at the end of maturity, this bond will pay you principal amount, which is $1,000, right? Whoever has the bond. You can buy this bond, sell it to somebody else. Whoever purchases that bond, at the end of maturity, will be getting $1,000, which is the face value, right? Principal amount. So what is the return on this bond? Interest rate, 10%. So that's your, 10% interest right now on this bond. So anybody who, buys this bond will get 10% return today. Okay. Now tomorrow, let's say interest rate in the market changes for some reason. You will understand why they change later on. We have models to understand that, and that's what we are going to learn later on when we combine both the demand for money and supply of money, how interest rates change, and who can change it. We'll talk about that. You will see the Federal Reserve Bank has a lot of influence on the interest rate in the market. So let's suppose tomorrow interest rate goes up from 10% to 20% in the market. Okay? Hypothetical numbers. So what it means is that tomorrow if you buy a bond for $1,000 face value, it will give you a 20% return, which would be $200. Okay? So today interest rate is 20%. So if you buy a new bond in time period 2, let's say you invest $1,000 in buying a bond, you earn $200 in interest income on this bond. Okay? Is that fine with everybody so far? What is happening in time period 1 and time period 2? Now, so my question is, let's suppose you bought a bond in time period 1 for $1,000. So you have that bond. Okay? And now it's time period 2. So you bought that in the previous period. Now you want to sell it. You need money. Okay? You have to buy a house or whatever you want to do with that. You are going to sell this bond to somebody. You are allowed to sell. Bonds can be traded in the secondary market. So suppose you want to sell your bond. The question I have for you is, now you're selling it in time period 2. Right? Tomorrow. My question is, will you be able to sell your bond for $1,000 that you paid to get it in time period 1? Anybody? So you bought this bond for $1,000 in period 1, right? And it pays you 10% return, $100 every period. Now you're trying to sell it to somebody else in time period T2. But that person also has the option of buying a new bond, which pays 20% return. So my question is, would you be able to sell your bond for $1,000? No? Anna?
I don't know. I don't think so. I don't know.
So you think you won't be able to sell it for $1,000? So would it be less? So if you try to sell it at a lower price than $1,000, would you be able to sell it then? Anybody? So let's look at it differently. So if I buy a bond today for $1,000, I'm guaranteed to get 20% return on it, right? That means $200 I will earn. But if I buy your bond for $1,000 today, I will just get $100 as promised by the bond issuer, right? So that's just 10% return. When I can earn, if I invest that $1,000 today in a bond, I'll get 20% return. So clearly nobody would be buying this bond, the old bond, for $1,000. So you have to lower your price. Then it might be attractive to a buyer in time period T2. So the question is, what is that amount at which somebody would be indifferent between buying your old bond and buying the new bond? Okay? In other words, what is the maximum amount that somebody would be willing to pay for your bond? So how do we find that? It's very simple. So we know today if you buy a bond, you get 20%, right? If you buy a new bond, you will get 20%. So 20% of some amount to be determined, call it X, okay? And if that amount is equal to $100, which I will get from this bond. If I buy old bond, I'm guaranteed to get, it doesn't matter at what price I buy, I'm guaranteed to get $100, right? Because that's what the bond issuer has promised me. Whoever has that bond will get $100 every year or in every time period. So it doesn't matter at what price you buy from me, you will get $100. That's guaranteed. So 20% I'll get a return today. I invest $1, I get 20% of that, right, today. So if 20% of X is equal to $100, then I'm indifferent between buying a new bond, which will give me 20% return, and the old bond, right, if those returns are equal. So what is X equal to then? 100 divided by 0.2. 20% can be written as 0.2. $500. Right? So your old bond, which you bought for $1,000 in time period T1, and now interest rate has gone up in the market, it's 20% in time period T2. So if you want to sell your old bond in time period T2, you have to reduce your price. And your price cannot be more than $500. Nobody will pay you more than $500. Because $500 is the amount at which somebody is, in time period 2, somebody is indifferent between buying your old bond that promises to pay $100 in return and a new bond that will result in 20% return. Now they are equal, the returns are equal here. You see that? So if I buy that bond for $500, 20% of that would be $100. Does that make sense to everybody? So what do you observe here? Interest rate went up from 10% to 20% in the market. What happened to the value of an existing bond? Went up or went down? Went down. And that's your inverse relationship that I wrote before. The value of an existing bond is inversely related to the current market interest rate. Okay? Let me give you a simple exercise for you, similar to this. Let's say, let me change the numbers and see if you can answer the question. So let's say in time period T, face value is $500. That's your face value. And it gives you $50 yield. And the interest rate basically over here is how much? 10%. And in time period 2, interest rate went down to 5%. So this is your information. Okay, face value of the bond you have is $500, pays $50, whoever has this bond. So the return on this bond is 10%. Now, today if you buy a bond in time period T2, interest rate currently is 5% in the market. So interest rate has gone down basically. So what is the maximum amount that you will get for your bond that you bought in time period T1? What's your answer, Faith?
1,000.
$1,000? That's correct. So, as you can see now, interest rate went down from 10% to 5%. The value of your outstanding bond went up, right? In this case, $1,000. You can make a profit from it. If you bought it for $500, now you can reap rewards for it by selling it, isn't it? So speculators, as I was talking about before, they try to speculate what will happen to the interest rate tomorrow. Will it go up? Will it go down? And based on that, they try to profit from it. And they have understanding of this relationship. They understand the relationship between the value of an existing bond and the interest rate. Go ahead.
So when you buy a bond, you try to watch the interest rate, and when it goes
Yes.
down, you sell it.
Yeah. So if you have a bond and your interest rate in the market tomorrow goes down and your existing bond is worth more now, so you can sell it at a profit. And if you have a bond today that you bought and that interest rate goes up, you don't want to sell it. If you sell it, you're going to make losses. So just hold on to it, keep on collecting your interest, and wait for the opportunity, good moment when it, interest rate might fluctuate again. Who knows in the future? All right. So let's come back to the diagram that I'm interested in here: quantity of money and interest rate. Now again, we have two interest rates, 2% and 20%. So now you're a speculator. You like to speculate on the interest rate. And you are thinking right now, interest rate is currently 2%. Okay? So right now in the market, interest rate is 2%. And your guess is that interest rate cannot fall any further. You're making a guess. And you are thinking that interest rate has already reached its bottom. And the only direction it will take tomorrow is up. So would you demand money or would you buy bond right now? If interest rate is 2% and you're thinking it will go up tomorrow. Demand money because?
The interest rate will go up, so the bond value will go down.
That's correct. If you buy a bond today, you will lose money, isn't it? So you would hold on to cash. You don't want to buy bond at this time because you are expecting the interest rate to go up tomorrow in the future. So at this interest rate, if you are a speculator, you would hold money. You'll put everything in your checking account. You don't want to buy a bond. Because you know, if you buy a bond and if interest rate goes up tomorrow as you're expecting it to, it will be worth less to you. So you don't want to buy a bond. And next, let's consider another interest rate. Hypothetically speaking, is very high, 20%. Now, what will be your behavior now? Would you demand money or would you buy bond? So this interest rate is too high in your opinion. Let's put it this way. You think it's not going to go up any further. It has already reached, the highest point it can go. Now, the only direction it will take is go down. So would you demand money or would you buy bonds? Buy bonds, because if you buy bonds, you will make a profit from it, right? So as much, bonds you can buy, you would try to buy, right? And that gives you this. And if you connect it, you will get your money demand once again. Now this money demand you are getting is due to a speculation. But again, this is also downward sloping, like the one you had with the transaction money. So demand for money actually is because of the two motives, transaction motive and speculation motive, and both of them give rise to the same demand for money. It's a downward sloping line. Is that fine with everybody? Okay, good. Now when you draw this demand for money, you're assuming inflation rate and real GDP remains the same. Next, let's talk about how the demand for money will change, shift either to the right or to the left if inflation changes or real GDP changes. Okay. After that, we'll stop for today. So let's say currently interest rate in the market is 10% over here. And at that interest rate, let's say the demand for money from households and firms because of transaction and speculation motives is $1 trillion. Okay? That's the total demand of money, M1, at interest rate of 10%, let's say. So currently interest rate is 10%. According to demand curve, $1 trillion are demanded by households and firms for transaction and speculation motive. And when you draw this, you're assuming that inflation rate and GDP are given to you. So let me give you some number. Let's say real GDP is $15 trillion, and overall price level or inflation rate is, let's say, 2%. Okay? So when you draw the demand for money, you're assuming these things are unchanged. And if they change, what will happen to the demand curve? Let's talk about that. So let's start with inflation rate. And to understand it, let me give you a simple example. And that will allow you to understand what will happen to the demand for money. So let's say currently, your demand for money, basically by demand for money we refer to how much money you have in cash, in your wallets basically, and in your checking account, right? Let's say you don't have a checking account, just keep things simple. You keep money in your wallet, that's your demand for money. And every day you go to the campus center to eat lunch, you buy a burger every day, and you pay $5. Okay? So your demand for transaction motive, you want to buy a burger. And thus, you need just $5, right? So demand for money is $5 per day for you, in this case. It doesn't matter what the interest rate is, right? Some interest rate, let's say interest rate currently in the market is 5%. Don't worry about it. You need to buy a burger, and therefore you need $5 every day. That's all you buy. Okay? So you need $5 in your wallet. Your demand for money for that day is $5. Now next, let's suppose inflation goes up. P is inflation, right? The overall change in overall price level. Let's suppose it goes up. So inflation, now let's say inflation is 100%, hypothetical number. Right? Price is double, let's say. Everything is expensive now because of inflation, and therefore your burger now is going to cost you $10 instead of just $5. So you still have to eat burger. How much money would you carry in your wallet now? Double, $10, right? So your demand for money is now, instead of $5, it's $10 for transaction money. Can you see that? So let's come back to this example. So currently, interest rate in the market is 10%, and at that, $1 trillion are demanded for transaction and speculation money by households and firms in the economy. Next, let's suppose inflation goes up from 2% to 5%. In other words, you have to pay more for everything. So what will happen to the demand for money? Will it still be $1 trillion at the same interest rate 10%, or will it be more? So at interest rate 10%, Earlier, demand for money was $1 trillion. Now inflation has taken place. Everything is more expensive. You have to pay more for everything, right? Would demand for money increase from more than $1 trillion? Would it be something else, or would it be less? Would it be the same? What is it? I know. It will be more because you have to pay more. For transaction model, you will demand more money. So if everybody does that, demand for money would be higher. Let's say $1.5 trillion. So at the same interest rate, 10%, now you will be at that point. You're not on the same demand curve anymore. So in other words, your demand for money will shift to the right. It increases. And now you have inflation rate of 5%, but GDP is still $15 trillion. That you didn't change. You just changed one thing. That was your inflation rate. It went up from 2% to 5%. GDP is still the same. Demand for money rises. It shifts to the right. Is that fine with everybody so far? Next, let's talk about real GDP. If it changes, what happens to the demand for money? So let's come back to this position. You're at this 10%, $1 trillion. Okay. Now, currently GDP is $15 trillion. Right? In other words, we are producing goods and services worth $15 trillion. And to transact that, when you produce goods and services, you also have to buy and sell, right? A lot of transaction activity will go on to support that kind of GDP. And we need $1 trillion to support that, okay? So basically what you are saying is that every dollar, can buy, every dollar can be used to, transact $15 worth of goods and services in the economy, right? Your yearly output, the value of your yearly output is $15 trillion, that's your GDP. And you have $1 trillion in cash in the hands of public, in firms, right? And you're buying and selling all these things. It can be done with $1 trillion. That's the idea. Because, dollar changes hands. I buy it from you, you get it, then you will use that money. So basically, you can see this. This $1, allows you to transact goods and services worth $15 in the economy, in this scenario, right? In a very